Happy New Year, everyone, and thank you for joining us for our 2026 Outlook. Today, we'll walk through what we're seeing in the economy, how we're thinking about markets, what we're watching closely, how we're positioning client portfolios, and what that means for you. Before we move forward, it's helpful to take a clear look back at 2025. It was a strong year for investors, and the gains were broad. U.S. stocks were solid, international markets performed well, commodities had a meaningful run, and even bonds contributed. That kind of environment naturally improves portfolio outcomes, but that strong performance also doesn't come without consequences. Valuations, particularly in the U.S. markets, are now elevated relative to history. Credit spreads are tight, which tells us risk is being priced aggressively, and in some areas, returns were unusually large. The chart on the right speaks to that sentiment. After a period of consistent gains, confidence tends to rise and the markets begin to assume fewer things can go wrong. This doesn't imply an imminent reversal, but it simply means the margin for error is much smaller than it was a year ago. So the takeaway from this slide is balance. We acknowledge the strength of 2025, but we also recognize that it sets a different backdrop as we think about risk, return, and portfolio positioning heading into 2026. We've organized our outlook around 10 themes that we believe are most relevant as we head into the year. These themes span the economy, policy, market behavior, and areas of opportunity and risk across asset classes. Our first theme is the economy. Despite the challenges of 2025, including trade disruptions and global uncertainty, the U.S. economy remained resilient. Growth held up, innovation continued, and U.S. capital markets remained a relative strength. Looking ahead, we believe supportive policy conditions should allow the U.S. economy to continue growing in 2026. As we look ahead, our expectation is for a modest pickup in U.S. economic growth. GDP is projected at about 2.2%, up from roughly 2% in 2025. We think 5 key factors are driving that change. First is the One Big Beautiful Bill. This legislation is expected to provide a meaningful near-term boost to household cash flow. Some of the changes, like no tax on tips, relief on certain investment income, overtime earnings, and higher SALT deductions, were applied retroactively back to 2025, so we expect tax refunds this year to be much larger than many expected. Our estimate is that the average household could receive up to about $1,000 more than they did in 2025. Second, that impact is even more pronounced for higher income households. Estimates suggest refunds for the top 10% could rise by roughly $14,700 per household. That matters because this group accounts for nearly half of all U.S. consumer spending. When you combine that with strong asset markets, it creates a meaningful tailwind for consumption this year. Third, we're seeing stronger business investment. Incentives like accelerated depreciation, along with continued spending tied to AI and productivity, are driving capital expenditures higher. Fourth, foreign direct investment remains an important tailwind. The U.S. is projected to attract close to $10 trillion in investment over the next decade across energy, manufacturing, technology, and autos. Now, if only a portion materializes, the economic impact is still meaningful. Even just a quarter of that would translate to roughly $250 billion per year, adding close to 0.8% to annual GDP. And then finally, there are the intangibles. With major global events and national milestones ahead, the U.S. remains in focus internationally. Historically, that kind of environment tends to support stability, investment, and economic momentum. Taken together, these factors provide a constructive backdrop for growth here in 2026. Turning to monetary policy, 2026 is likely to be a transition year for the Federal Reserve. Leadership is changing, and the focus will remain on balancing inflation, growth, and financial stability in an environment that's the Fed's mandate centers on inflation and employment. Starting with inflation, we expect it to remain somewhat above the Fed's 2% target for much of 2026. That said, There are two developments worth noting. First, some of the recent upward pressure tied to tariffs appears temporary and should fade over time. Second, and more importantly, the parts of inflation not directly affected by tariffs are showing signs of moderation. Shelter and service related categories like healthcare and transportation account for roughly 2/3 of the CPI basket, and those areas are gradually cooling. So while inflation may stay elevated near term, the broader trend remains disinflationary rather than structural. So that means the Fed's primary focus will shift to employment, and the labor market is losing momentum. Job growth in 2025 was one of the weakest years outside of a recession, slowing from over 6 million jobs in 2022 to under 700,000. Wage growth has cooled across all income levels, with the sharpest slowdown among lower income workers. At this pace, wages for the lowest earners could soon fall behind inflation, eroding real purchasing power. And layoffs are rising. Over 1.2 million last year, on par with a great financial crisis. The unemployment rate has already ticked up from 4.1% to 4.6%. When we consider all this data together, the labor market is clearly softening and the pressure is greatest on lower income households. In 2026, leadership at the Federal Reserve will transition as the current chair, Jerome Powell's term ends. Regardless of who steps into the role, the key point is continuity. The Fed is committee-driven, and we expect its independence and decision-making framework to remain intact. Policy should stay data-dependent, with a focus on inflation, employment, and financial stability, not short-term pressures. Under that framework, our base case is for one additional rate cut in 2026, taking the upper bound of the Fed funds rate to around 3.5%. Our third theme is volatility. For much of 2025, markets were unusually calm. Outside of a few brief periods, trading conditions were relatively steady, even with all the uncertainty. The S&P 500 saw just two pullbacks of 5% or more, compared with a more typical year where we'd expect closer to 4%. There was one larger decline after Liberation Day of just under 20%, but that was followed by a very rapid recovery, only about 56 trading days. By year end, all 11 equity sectors finished positive, and the gap between the best and worst performers was the narrowest we've seen since 2018. Fixed income showed a similar pattern, bond yields trading in their tightest range since 2018, and the Bloomberg aggregate delivered its strongest performance since 2020, with all major fixed income sectors ending the year positive. When you see this combination, limited pullbacks, narrow dispersion, and broad participation, it typically signals a market environment that's unlikely to persist. And that's why we expect volatility to increase as conditions normalize this year. Looking ahead, there are several potential catalysts that could bring volatility back in 2026. On the economic side, if growth runs hotter than expected or policy eases too aggressively, inflation pressures could reemerge and push rates higher. In equities, we're likely to see an active IPO pipeline this year, particularly in technology and AI. If some of those offerings disappoint, it could challenge current valuation assumptions. On the fixed income side, confidence remains solid, but shifts in policy expectations or concerns around central bank independence could lead to higher rate volatility. And geopolitically, disruptions, particularly those affecting energy and commodities, remain an ongoing risk. We're not suggesting all of these will occur, but in an environment where volatility has been unusually low, overlooking these risks would be a mistake. The takeaway is preparedness, staying diversified, disciplined, and ready to adjust if conditions change. Theme 4 focuses on the role of the bond market in mitigating portfolio risk, providing stability and balance during periods of uncertainty. If you look back at major periods of market stress, a consistent pattern shows up. During episodes like the Great Financial Crisis, the European debt crisis, COVID, and more recently the yen carry trade unwind in 2024, Equities experienced sharp drawdowns. In contrast, high-quality bonds generally held their ground and in most cases delivered positive returns during those same periods. That diversification benefit is important. It's not about eliminating volatility, but about reducing its impact and creating stability when risk assets are under pressure. This is why bonds continue to play a critical role in portfolio construction, especially in environments where volatility is likely to be higher. A key piece of context on interest rates is that the policy backdrop has changed. The Fed is no longer actively suppressing long-term yields through large-scale bond purchases as it did back in the 2010s. At the same time, it's also no longer aggressively shrinking its balance sheet the way it was over the past couple of years. As a result, the 10-year Treasury has settled into a more market-driven range that looks similar to the early 2000s, roughly 4 to 5%. Our base case is that yields remain range-bound, with the 10-year ending 2026 around 4.25% to 4.5%. That view is supported by modest economic growth, stable employment, and continued demand for treasuries. For yields to move meaningfully below 4%, we'd likely need a recession and rising job losses, which is not our forecast. On the other hand, a sustained move above 5% would likely require either much stronger growth or renewed inflation pressure. Looking ahead, we expect a modest steepening of the yield curve in 2026. Short-term rates, like the 2-year, should remain relatively anchored as the Fed likely delivers one additional cut to support the labor market. Longer-term yields may drift slightly higher, but that said, we don't expect a sharp move higher in yields. Demand for treasuries still remains strong. Foreign holdings of U.S. treasuries have reached a record level, and auction metrics like bid-to-cover ratios continue to signal healthy appetite for U.S. debt. Taken together, this points to gradual curve steepening rather than a disorderly rise in rates. One important long-term dynamic for bonds is income. Historically, the majority of bond returns have come from interest payments, not price appreciation. The chart on the left shows that income has consistently driven returns over time, while price moves have been relatively small. Looking ahead, with interest rates expected to remain relatively stable, bondholders should earn returns close to current yields. That puts high-quality bonds in the range of roughly 4% to 5% over the coming year. From a positioning standpoint, we continue to favor high-quality exposure, particularly investment-grade bonds and muni bonds, where yields remain attractive relative to their long-term averages. High yield, on the other hand, is trading close to its historical average, which suggests investors are not being meaningfully compensated for the additional risk. The bottom line, bonds are once again doing what they're meant to do, provide income and stability within portfolios. Theme 5 is U.S. equities. After a historically strong run, the size of returns and what's driving them is changing. Markets can no longer rely on expanding valuations to do the heavy lifting. Going forward, returns are likely to be driven more by earnings growth and fundamentals than by multiple expansion. 2025 was quite the year for equities. Despite a nearly 19% drawdown in the spring tied to tariff concerns, the S&P 500 still finished the year up about 18%. The market's now been up 6 out of the last 7 years, and periods like this tend to reset expectations. Looking ahead, we expect returns to be more moderate, though still positive. The question now is less about whether equities can continue to grow and more about what will drive returns from here. When we look at our equity dossier, the data behind our outlook, the message is fairly straightforward. We don't see a recession ahead, which supports revenue growth, margins, and earnings staying above long-term averages. Fundamentally, the equity backdrop still remains solid. At the same time, rate cuts in a non-recessionary environment tend to be supportive for stocks. They help sustain growth while making equities more attractive relative to cash and short-term rates. History is also supportive, though not without caveats. The fourth year of a bull market has typically produced more moderate gains, which is consistent with our broader return expectations. Midterm election years often bring higher volatility along the way, but they have generally ended with positive returns. All of this sounds like positive news, but it's important to balance that with some caution. As we've said, valuations are elevated near the 95th percentile, but they're not necessarily disconnected from fundamentals. Companies are far more profitable than they've been historically, and higher margins do tend to support higher multiples. The chart in the middle shows that relationship clearly. As margins rise, valuations generally follow. With margins near 14%, today's valuations are largely justified. That said, we don't expect valuation expansion to drive returns, which means earnings growth will need to do most of the work in 2026. Positioning is also a constraint. U.S. households now hold about 45% of their financial assets in equities. That's a record level, and that limits how much incremental demand can push the markets higher from here. Our models point to S&P 500 earnings growth of roughly 10 to 12% in 2026, which puts earnings around $300 per share, with AI and large cap technology continuing to be the key contributors. Applying a 24 times multiple, roughly in line with today's market, gets us to our year-end target of about 7,250. That base case assumes the economy stays on solid footing, inflation continues to cool gradually, and the Fed delivers one rate cut. On the downside, a meaningful reacceleration in inflation, potentially tied to tariffs, could force a more hawkish Fed and pressure margins. In that scenario, earnings closer to $285 would support a downside case near 6,200. On the upside, stronger than expected economic growth, paired with continued disinflation and a more accommodative Fed, could support earnings expansion at higher multiples, leading to a bull case closer to 8,200. Overall, while risks remain on both sides, our outlook carries a modest bias towards the upside.
Let's dive into our sector themes. Tech is still our favorite despite many investors becoming nervous about AI. Now let's address the elephant in the room. What is making investors nervous about the technology sector? One of the biggest concerns we hear is that technology is getting too expensive. But if you look at the data, that's not really the case. On the chart on the left, you'll see that today, the tech sector is trading around 27 times earnings. That's actually lower than where it started in the beginning of last year, when it was closer to 29 times. And if you go back 5 years, valuations are roughly in the same range. So why has tech continued to rally if valuations haven't expanded? The answer is earnings. Tech earnings growth last year was more than double that of the broader S&P 500, and we expect that trend to continue into 2026. Strong earnings are doing the heavy lifting. And for anyone worried about a repeat of the dot-com bubble, it's important to keep perspective. At the peak of the dot-com era, the Nasdaq was trading at about 90 times earnings. Today, it's closer to 34 times, roughly a third of that level. So from a valuation standpoint, we do not see this as a dot-com redux. The second major concern is rising capital investment and leverage. It's true that some firms are spending more and taking on debt, but perspective is important here. Tech's capital investment as percentage of sales sits right in the middle of the 11 sectors. And as far as debt, tech still has the lowest leverage of any sector. Another risk we're watching is policy. Some state and local governments are pushing back on new data centers due to power costs. That could become a major talking point in midterm elections. But the president continues to champion U.S. leadership in AI, and even if data centers need to relocate, plenty of regions would welcome that investment. Bottom line, these are headline risks, not fundamental game changers. Our next theme focuses on two sectors that have been hiding in the shadows, two overlooked underperformers. Our two contrarian picks are consumer discretionary and healthcare. When it comes to consumer discretionary, this is an area where we think there's a potential for surprise comeback. A lot of bad news is already priced into this sector. Tariff concerns, fears that consumers are running out of money, and constant headlines are slowing spending. But when we look ahead, the picture is actually more positive. First, job growth is expected to improve this year, averaging about 80,000 new jobs per month. That's a meaningful pickup from last year. Second, consumers are set to receive about $140 billion in tax refunds, which should support spending. If you look at the chart on the right, you'll also see that the sector is trading at a discount. In fact, it was the least favored sector in our firm's most recent investment strategy survey, which often creates opportunity. And it's important to remember how diverse this sector really is. It's not just retail. It also includes autos, restaurants, travel, and home improvements, all areas where consumers continue to spend. So overall, we see several paths for consumer discretionary to perform better than expectations over the next year. Healthcare is an underdog with upside. In 2025, healthcare underperformed for the third straight year, but if you look at this chart on the left, it has never underperformed for 4 consecutive years, so we are expecting a bounce back. One of the main reasons we continue to like this sector is because, from our lens, it's one of the cheapest sectors in the market. We believe policy rhetoric could potentially create opportunity for this sector. And we also have to remember that this sector that is known for innovation. And just a couple of weeks ago, we saw US regulators make an announcement for an approved oral medication to treat obesity. So healthcare is one of those few areas where valuations alone make a strong case, but we think this policy-driven underperformance is a buying opportunity, and recent rallies prove just how quickly sentiment can flip. In theme number 8, we will be focusing on energy and power. For years, oil was the driver of the energy story. Now, the data center boom has flipped the script, shifting the focus to electricity. As companies race to build more data centers, power demand is skyrocketing. Here's an interesting stat. Every single AI query uses enough electricity to run a microwave for about 1 second, watch TV for a few seconds, or keep a light bulb on for 10 seconds. Sounds tiny, but when you multiply that by billions of prompts every day, the total energy demand is massive. And if you're generating images or videos with AI, that's even more power use. When you think about who benefits, the obvious answer might seem like the utility sector. But here's the catch. Utilities require huge capital investments, and their rates are regulated, so they may not be able to quickly increase their prices. So utilities is not necessarily the best play, especially since its valuations have gotten more expensive. We prefer the industrial sector, the real picks and shovels behind the AI build-out. These companies are seeing explosive demand for electricity and power generation equipment for data centers. Solar panels, batteries, and transmission lines for the grid are made by industrial companies. With industrials, investors also get exposure to other secular growth drivers, like replenishing and expanding global defense stockpiles. In most cases, there is a major gap between 2025 defense spending percentages and the new target NATO has established. These themes are well insulated from macro shocks and form a key part of our 2026 sector investment thesis. Now to commodities. When it comes to energy, we're still underweight because supply growth is expected to run about twice as fast as demand growth again in 2026. With oil likely stuck in the $55 to $60 range, energy stocks could deliver a subpar performance again in the near term. Rare earth minerals are getting a lot of attention. These are critical components in everything from smartphones, MRIs, to electric cars, and now they're considered vital to national security. However, there's zero exposure to rare earth metals in the S&P 500 and limited exposure in small caps, and it's expensive. While rare earths may be a hot topic, they're not a practical play for most investors right now. Next, we will be discussing international markets. International markets were the spotlight in 2025, and for a good reason. The EFA index outperformed US by its widest margin in US terms since 1993. But looking ahead, the key question is this the start of a durable trend for internationals, like the one that persisted in the early 2000s, or is it just another flash in the pan? When it comes to developed markets, we still favor the US, and here's why. First, the currency tailwinds that boosted international markets last year have faded as the dollar stabilized, with the dollar likely to hold steady in 2026. Those gains won't repeat. Second, the US should benefit from a more market-friendly policy mix. Another Fed rate cut and upcoming fiscal stimulus should support US equities. Compare that with Europe, which is likely done with its rate cuts, and Japan, which just raised rates to a 3-decade high. Third, fundamentals favor the US. When it comes to growth, the US economy is expected to once again outpace Europe and Japan, despite Europe's fiscal spending initiatives and Japan's pro-growth policies. While earnings are improving across the most major markets this year, The US is still expecting to post the best earnings growth in 2026. And finally, sector leadership matters. As you can see on the chart on the right, the US has the highest weightings to sectors that are driving the best earnings growth and upside potential, with nearly 70% of the index allocated to the sectors we like in the US. When it comes to the emerging markets, we still find EM attractive relative to developed markets, with our preferred region being EM Asia. However, selectivity across markets and sectors is key. While EM Asia doesn't have the multi-trillion-dollar tech giants like the US, the AI boom has made tech a growing part of the index. Countries like China, South Korea, and Taiwan are home to some of the leading players. In fact, 7 out of the top 17 tech companies reside in Asia versus only 1 in Europe. As a result, tech shares of EM have risen from about 18% in 2015 to around 27% today. And that's important as tech remains one of the preferred sectors. Plus, EM information tech is attractively priced, trading at a significant discount to US tech names. Within EM Asia, one particular area we like is India. Now, India lagged considerably last year. It underperformed other emerging markets by the widest margin in 3 decades. However, going forward, we think India is set up for a big rebound this year because it has the fastest growing economy, has favorable demographics, and has rising foreign investment. Our last theme is asset allocation. Let's be honest, investing is not a straight line to the top. Asset allocation is your blueprint for navigating market twists and turns without dangling from a ceiling. Let's take a look at this chart. The S&P 500 hit nearly 40 record highs last year alone, but those highs came with plenty of bumps along the way. Since 2000, we've seen 23 pullbacks of 10% or more, and 5 bear market drops of 20% or more, often tied with the 3 recessions we have had. Yet, over the past 25 years, the S&P 500 is up about 660%, an average of 8% per year. You may be thinking, should I invest when the market is at a record high? And here's the surprising truth. If you invested on those record high days versus any other day, your returns were just as good, if not better. And it's important to remember that time in the market is more important than trying to time the market. And that's a reminder that successful investing relies on consistency, discipline, and a long-term plan. We'll continue to monitor the landscape closely and keep you informed as things evolve. And that concludes our Market Outlook video. As always, thank you for your continued trust, and we wish you a fantastic year ahead.